As of 11:35 a.m. Eastern Time on September 22, 2025, SoFi Technologies, traded under the ticker SoFi, is currently priced at $30.05, marking an intraday increase of about 1.92%. This move is happening on significant volume, suggesting that institutional interest is picking up. Now, the immediate reaction might be to attribute this to a recent analyst upgrade, perhaps the one from Mizuho that bumped their price target to $31. But that's the surface-level narrative, the expectation. The reality is far more nuanced and speaks to a deeper recalibration of how the market is beginning to value this fintech disruptor. We're seeing a potential shift from viewing SoFi as just another high-growth, high-risk neobank to recognizing it as a foundational financial technology company with multiple, powerful revenue streams that are now hitting their stride. The common belief has been that SoFi is a story about student loan refinancing, and therefore its fortunes are tied to interest rate cycles and federal policy. While that was its origin, clinging to that view today is like judging the entirety of Apple stock based on Mac sales in the early 2000s. The real story, the one that the intraday price action is starting to reflect, is about the powerful synergy between its lending, financial services, and, most critically, its technology platform segment, which includes Galileo. This isn't just a bank, it's an ecosystem, and the market is slowly awakening to the profound difference. The recent stock movement has been anything but quiet. We've seen considerable volatility, with numerous sessions experiencing swings greater than 5%. This isn't unusual for a stock that has more than doubled since the beginning of the year, hitting new 52-week highs along the way. Profit-taking is natural, creating dips that are quickly met with buying pressure. This tug of war is evident in the trading volumes, which have consistently been elevated. Institutional ownership provides a clearer picture, with over 1,000 institutions holding positions, including giants like Vanguard and BlackRock. It's clear that the so-called smart money has a significant stake. Their continued accumulation, even at these higher valuations, signals a long-term conviction that transcends the daily noise. This institutional backing is a critical stabilizing force and a counter-narrative to the persistent, yet increasingly outdated bear thesis that focuses on valuation metrics like a high forward PE ratio. When you see a forward PE that's significantly higher than the industry average, the expectation is that the stock is overvalued. The reality, however, is that traditional valuation metrics often fail to capture the exponential growth potential of a company that is successfully executing a multi-pronged strategy. The focus shouldn't be on the static PE ratio, but on the PEG ratio, which factors in growth, and SoFi's growth has been nothing short of explosive. To truly understand the current momentum, we have to look at the latest financial disclosures. The second quarter 2025 earnings report was a watershed moment. The company didn't just beat expectations, it shattered them. Adjusted net revenue soared 44% year over year to a record $858 million. Net income saw a staggering 459% increase, reaching $97 million. This isn't just growth, it's accelerating, profitable growth. Management even raised its guidance for the full year, a clear sign of confidence in the underlying business momentum. The drivers are clear. Record member growth, with 850,000 new members joining in the quarter to bring the total to 11.7 million, and a corresponding surge in product adoption. This flywheel effect, where a customer comes in for one product, like a personal loan, and then adopts others like SoFi Invest, SoFi Money, or a credit card, is no longer a theoretical concept. It's a quantifiable, revenue-generating reality. Many investors using platforms like Fidelity, Robinhood, or Interactive Brokers for their individual brokerage accounts are watching SoFi not just as a stock to trade, but as a legitimate competitor that's rapidly gaining market share. At its core, SoFi operates a comprehensive digital personal finance ecosystem. It started with a focus on refinancing student loans for high-earning individuals, a lucrative niche that allowed it to build a strong brand and a valuable customer base. From there, it has methodically expanded its offerings. The lending segment now includes personal loans, home loans, and in-school loans. The financial services segment is a one-stop shop for modern banking, featuring a high-yield checking and savings account, an investment platform called SoFi Invest that offers both active and automated investing, akin to Schwab Intelligent Portfolios, credit cards, and insurance products. This comprehensive suite is designed to capture a customer's entire financial life. The third and arguably most underappreciated pillar is the technology platform segment, powered by its acquisitions of Galileo and Technisys. Galileo provides the back-end infrastructure for many other fintech companies and neobanks to issue cards and manage payments. This B2B segment provides a steady, high-margin revenue stream that diversifies the company away from the cyclical nature of consumer lending. In Q2 2025, this segment posted nearly $110 million in revenue, a 15% increase year-over-year, demonstrating its continued expansion and adoption. The future outlook is where the expectation versus reality framework becomes most critical. The expectation held by bears is that macroeconomic headwinds, such as a potential economic slowdown, will inevitably lead to credit deterioration and hurt SoFi's lending business. They also point to a competitive fintech landscape and pressure on net interest margins. The reality is that SoFi is better insulated than its peers precisely because of its diversified model and because it focuses on a high-quality credit demographic. The acquisition of a national bank charter was a pivotal moment, allowing SoFi to fund its loans with its own member deposits rather than relying on more expensive third-party capital. This provides a significant cost advantage and greater control over its financial destiny. Furthermore, the technology platform acts as a powerful hedge. As more financial and non-financial companies seek to offer embedded finance solutions, a major industry trend, Galileo is perfectly positioned to be the foundational layer for this next wave of financial innovation. Comment below with your thoughts on whether SoFi's technology platform or its consumer-facing bank will be the bigger growth driver over the next 5 years. Looking ahead, several catalysts could propel the stock further. Continued execution and strong quarterly reports that demonstrate sustained member and product growth are paramount. The expansion of Galileo's client base, both domestically and internationally, will be a key indicator of the technology segment's health. The market is also closely watching the company's progress toward achieving sustained GAAP profitability, a milestone that would force many skeptics to reevaluate their thesis. Risks, of course, remain. A severe recession would undoubtedly impact loan demand and credit quality across the entire financial sector. The regulatory environment for fintech is also constantly evolving. And as a high-growth company, SoFi will need to continue investing heavily in marketing and technology to maintain its competitive edge, which could impact short-term margins. However, the management team, led by CEO Anthony Noto, has a strong track record of navigating these challenges and executing on their long-term vision. In summary, the current price action in SoFi stock is not just a fleeting reaction to an analyst note. It is the beginning of a broader market recognition that the company has successfully transitioned from a monoline student lender to a diversified financial technology powerhouse. The expectation was that SoFi was a high beta play on student loans. The reality is a vertically integrated ecosystem with a coveted banking charter, a rapidly growing consumer financial services division, and a B2B technology platform that serves as the backbone for the future of finance. The narrative is shifting from risk to resilience, from potential to proven execution. The company is no longer just a disruptor. It is becoming a formidable incumbent in the digital finance space, a reality that the market is finally and powerfully starting to price in.